Welcome to Multifamily Rock Stars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. All right, so today we have Zach Haptonstall. He's a multifamily syndicator and lead sponsor living in Phoenix, Arizona. He currently owns over 300 units and $35 million of assets under management, all in Phoenix and Scottsdale, Arizona. He's the founder and president of the Phoenix Multifamily Association, where he and his fiancee, Grace, hold monthly events focused on multifamily education and networking. Zach, thanks so much for joining us today. Pleasure to have you on the show.
Yeah, no, thank you, Ryan. I really appreciate it, man. Thanks for having me on the show. I'm very grateful. I know you and I met last year at some different conferences and have grown to be friends, so I appreciate you having me on.
Awesome. Awesome. Fantastic. I have a number of questions for you. And, I think the first one is just walk us through your background and just tell the listeners a little bit about yourself.
Yeah. So a quick background on me. So I was born and raised here in Phoenix, Arizona. So I pretty much lived here my entire life. I played football. I wanted to be an NFL football player, but I wasn't big enough or good enough, Ryan. So I went to a Division II school, realized it wasn't going to work out. I wanted to be a sports reporter, so I got a journalism degree in broadcast journalism. And I was actually a live news anchor and a sports reporter on Arizona PBS for about 5-6 months. And I hosted a show on Fox Sports Network Arizona, which was really cool at first, being on TV and everything. And then I quickly realized you work a ton of hours, you don't make a ton of money. It's very political. And so I was like, man, I don't want to do this. And so at the time I was delivering medical equipment nights and weekends to pay for school. And I found out you can make pretty good money doing healthcare marketing. So I graduated, I had all this student debt, and I was like, you know what? I need to make money. So I went into hospice marketing of all things. So I don't know if you're familiar with hospice care.
A little bit just from talking with you before. Yeah.
Yeah. So basically mobile nursing and caregiving for people who have end of life illnesses. So my job was to wake up in the morning and drive all around town and just walk into hospitals, doctors' offices, assisted livings, and build relationships with physicians, social workers. And they had somebody need a hospice, they call me, and I would meet with that family, educate them, sign them up. So long story short, it sounds kind of weird, but hospice is actually an extremely competitive and lucrative private business industry. And I was very fortunate to do well in that at a young age. So I just started as a marketer. I then became the director of marketing. I then became a co-owner in the company. That's great. So from about 4 to 5 years, my early 20s, I was making over $200K a year, got my MBA, paid off all my school. I bought a house. By the time I was 23, I was making more money than both my parents combined. So I was very blessed to be in a good situation, but I had already kind of done the Dave Ramsey thing, right? I killed all my debt. I was just stacking up money, and I had no other goals. And so I was getting burnt out, working like 60, 70 hours a week, doing something I was no longer passionate about. And I was just always on call. So I was like, man, I don't want to do this anymore. And so it was January of 2018. I had no plan, but I realized I didn't want to do that anymore. And I had no time to figure it out what I wanted to do. So in January 2018, I resigned and I sold my equity in the company. And I said, I'm going to figure out how to create passive income. Okay. And I didn't know anything really about real estate. I don't have any family in real estate. I don't have like any family money or anything like that. But I said, I'm going to live off of savings for the next 12 months. And I'm going to figure this out. So I read Rich Dad, Poor Dad, like everybody, as the cliche story goes. I started reading all the books, podcasts. I was really originally looking at flipping houses. I then learned about mobile home parks, and I cold called over 90 mobile home park owners.
Wow.
That was a cool cash flow vehicle. So anyways, long story short, I spent a lot of time doing that. I discovered multifamily and syndication, and 10 months later, we finally got our first deal under contract. So we can go into any details you want to do, but basically that was kind of my lead up into multifamily. I literally was just grinding it out, and I was trying to figure out how I could advance and learn.
Sure. No, I love, from the times that we've talked before, I really inspired, and I think, our listeners will be inspired by your story about, walking away from a pretty lucrative career and trying something new, and just having that goal, that hunger and that drive to go out there and cold call and just hustle. So, tell us about why you decided, that, real estate, passive income, multifamily apartments were what you wanted to do.
Yeah. So, what I was really looking for, Ryan, was I wanted to capture freedom of my time. You know what I mean? The money wasn't as important anymore as like the time. And I wanted to have cash flow or some type of passive income so I could do other things. And so when I was learning about real estate and listening to the podcasts and reading the books and meeting with people, I just started to realize this is a tremendous wealth building vehicle, you know, because you're gaining equity through natural appreciation. You can force the appreciation. You're getting cash flow. And so I realized that in the short term, I wasn't going to make any money off of this, or hardly any money. So I needed to survive. So this whole time, the last 24 months have really been survival mode for me. I'm just trying to make ends meet because I invested all the money I had into these deals, but I realized it's growing exponentially. And so for me, it was to get that freedom is why I realized it was a long-term play.
Okay. No, that's great. That's great. And then tell us about, you know, you cold called 90 people on the mobile park side. You know, what was the outcome there, and what got you into the multifamily?
Yeah. So I was actually talking to a guy. He owned a few mobile home parks here in Phoenix, and he told me what he does. And so basically what I was doing is I would go on a website and I would find all these different properties, like in an area I was targeting, which was like Mesa, Apache Junction, the East Valley. I'd find the LLC that owns them on the county assessor. And then I subscribed to like one of these data websites, like I think it was called Spokio. There's a bunch of them, which basically penetrates the corporate veil and tells you who owns the LLC.
Okay.
So it gives you phone numbers. So I made like a spreadsheet and I just started calling all these people. And again, I called over 90 of them. I think 6 of them answered. Okay. And like 4 or 5 of them lived in California. And they all said, no, I'm not selling. Like, leave me alone. Okay. And there was another, I tried to buy one on a seller carry because this guy was actually going to sell, but some other guy got it. Didn't work out. So I was extremely discouraged. You know what I mean? And it's just like you don't have the confidence and you don't know what you're doing. And so, and I think a lot of people trying to get a multifamily feel that way too. So you almost have to fake it till you make it and keep taking those scary steps forward until you gain the confidence and realize you can do this and you're comfortable and that you quote unquote belong.
Sure. No, that's great. So, you know, as you look at, you know, we just started this year, what are your goals for 2020?
Yeah, I need to probably reset my goals because my goals were to get 1,000 units last year and we got like a little over 300. So we didn't quite hit that. But my goal now was to get 1,000 units or 2,000 units total by September 1st of 2020, which is a lot. Okay. 1,500 units. And so I'm still writing that down every morning and sticking to that goal. And so we need to really scale up more quickly. But yeah, by September 1st, 2020, I want to have over 2,000 units, increase my net worth by 5 million. And then I want to have 10,000 a month in passive cash flow. So those are my real estate.
Wow, those are pretty ambitious. So increase your net worth by $5 million. Just, you know,
they're pretty lofty. Yeah. So it would be. You have to get a lot of units to make that happen.
You got it. So what are you doing? I mean, if you break that down into steps, what are you doing to make that a daily reality?
Yeah. And so, I mean, we're constantly looking for deals. I mean, we haven't closed any deals since August now. So it's been about a little over 5 months and it's been tough. Inventory's been low, but I mean, we're constantly talking to brokers, constantly underwriting deals, multiple deals a week, touring deals. And that's the thing with these goals and with multifamily in general, like you can set really ambitious goals and you do have to relentlessly attack in order to make these deals happen, but you also have to be patient, right? Sure, it's kind of a catch-22 because you don't want to buy crappy deals. Got to be careful. So, I mean, we're really doing what we constantly do is just constantly talking to brokers, underwriting deals, touring deals and making offers. I mean, we've gotten second place on a couple deals just in the last couple months. We had one deal accepted offer and then the seller backed out. So we've been getting close. You just got to keep attacking.
Sure. Now, are you doing this full time, Zach, or?
So yeah, so I was full time. So from January of 2018 until September, October of 19, I was full time.
Okay.
So about a little over a year and a half. And like I was saying, in August of 2019, which I don't regret. Like on the front end, I was burning through savings. It was very tough mentally, but it built a lot of determination for me. And for me on the front end, I learned so much, and it was a lot just to build out the infrastructure. But after we acquired those deals, I mean, I have a partner, Robert. He's also full time, and he's doing asset management. And so I was kind of going crazy, Ryan, because I was getting bored. Like if you don't have these deals going, I mean, the asset management, I'm on all the property management calls each week, and but when you got another guy doing asset management, I was low on liquidity because I invested all my money. And so I took a job. I'm now the president of a hospice organization here in Phoenix, Scottsdale area.
Awesome.
So, but it allows me flexibility, which is nice, where I can do both. And that's the cool thing about real estate is it's mostly telephonic or on the computer. So I don't necessarily have a boss. I'm very flexible and out in the field a lot. And so now I'm doing both, and I can time block, and I feel like I'm actually more efficient with the real estate. And so that's what I want people to know, like your listeners, Ryan, is that like for me, yeah, I went full time and didn't make any money, and it sounds cool, right? But it's not necessary for you to be successful. Like for me,
okay.
Yeah, Grace and I, we don't have kids, so we were flexible to do that. I was fortunate to have a lot of money saved up, and I could do that. But I don't want people to think that that's what you have to do in order to get into multifamily, because it's not true. I mean, I know a ton of people who have a full-time job who are doing it, and now I'm back to having a job and doing real estate. And so I think you can absolutely do both.
And how do you manage both of those? I mean, that's great that you can, you're able to do both. So how do you kind of any tips or advice you could share with the audience?
Yeah, I mean, it really depends what type of job you have. I mean, for me, like a typical day for me is I stop into our office for an hour or two every morning, like 8 to 10, and I check in with our administrator, our director of nursing, and kind of go over high level stuff for the day. And then a lot of time I'm out in the field training our marketers, working with staff. And so I'm very flexible. And so for me, my passion is real estate, and I prioritize real estate. You know what I mean? And so, I mean, I read a book called The One Thing by Gary Keller. I think a lot of people have read that. And it just talks about time blocking throughout the day. And so if I've got meetings for real estate, then those are most important. Or if I have phone calls or conference calls or tours, whatever, and I'm out in the field, I can do those calls in my car with my hotspot, and then I can go deals or whatever. So it depends on your job. I mean, if you have a traditional W-2 where you're in an office and you can't escape, you have to leverage your free time. You have to leverage your lunch breaks before work, after work. Like stop watching Netflix and get off the internet and all this other crap.
Kind of the old saying, if there's a will, there's a way.
Yeah, exactly. Yeah, you have to take advantage. You squeeze that time out.
For sure. And so, as you made that transition back to, picking up another job, how did your partners feel, and how did you kind of, settle out with them?
Yeah, we discussed that on the front end, because that's very important. I said, hey guys, I'm thinking about going back and getting a job because there's just not a lot for me to do. And initially when we had our partnership, we were kind of all doing everything. Okay. So we were all kind of involved all around, and our goal is to scale up. And we've just created Summit Equity, this entity, my partners, Bikram, Robert, and I. And so we wanted to really emphasize our roles. And so my role is acquisitions primarily. Robert's role is asset management. And then Bikram is kind of a hybrid between those two roles. Okay. So he helps us underwriting on the front end, and then watching financials and the general ledger during asset management. And so, yeah, that was communication that we all had. And literally every week, Ryan, I'm checking in. I'm talking to these guys almost every day anyways, but I'm saying, hey, is there anything you want me to do? Do you want me to be more involved with asset management? Because I want to make sure that they feel like supported. You know what I mean?
That's great.
So I think it's important. And that goes to another point, and we can touch on that. But it's like you have to find complementary business partners.
Sure.
Everybody has to be on the same page, and they should have strengths that you don't have, and vice versa. And that's how it can make it work.
That's a great kind of pivot point, because that's so key in multifamily and in any business that you're running, is the people that you're working with. So I know that, in our previous conversations, I believe you had started with a group of partners. Just walk us through, perhaps the personalities and the partnerships that you had, and then kind of the transition to kind of your core group now.
Yeah, I mean, you'll hear it a lot. You'll hear the cliche, like it's like dating, right? Trying to find your partnerships. And that's absolutely true. It is like dating. And so when you're starting out and you find other people that you think you might want to partner with who are interested in doing multifamily, well, then try to find out what their strengths are and see what their communication is like. Do they get back to you in a timely manner? Are they working as hard as you? Because I went through at least probably 5 or 6 different partners. And when I say partners, we didn't actually have a deal together, but we were underwriting deals, thinking about partnering, making offers together. But a lot of these people, some of them were more experienced, and I feel like they were trying to take advantage of me. You know what I mean? They're saying, oh, well, you do all the work and I'll raise the money or lend my experience. And
you tell us when you have a deal.
Yeah, exactly. And that's not what you want, right? Because it's tough. I mean, Ryan, it's good to have at least one primary partner who's grinding it out with you, and you guys can work together and go through the adversity, and you're working. So yeah, you need to just kind of find, like you really do need to like your partners. You need to be able to get along. You need to have tough conversations. You need to be able to be real with them. And you want to have a relationship, in my opinion, where you hold them accountable and vice versa. So there's been in the past where some of my partners, they're not holding their weight, I'll tell them. I say, hey, you really need to do this and this. Like, we need you to do this. You can say it in a respectful way. And I always tell them too, I say, if you feel like I'm drifting off or not doing a good job or whatever, then please tell me. Sure. Because you have to have that open communication.
No, that's great. That's great. Awesome. And then, let's switch to kind of deal analysis. And, it sounds like you've been looking at a lot of opportunities. Walk us through your underwriting process and, what are the 3 to 5 things that you look for in a good deal or a deal that, just deal killers that you say, hey, we're not going to spend time on this.
Yeah, absolutely. Yeah. I mean, so this obviously this doesn't apply to every market or every business plan, but our business plan, we're only looking in Phoenix, really. We feel like we have an advantage here because we're local and we understand this market. We don't want to be in any other market right now. So Phoenix is a very hot market. Cap rates are compressing by the day, it seems like. The price per door keeps going up. The fundamentals are extremely strong as far as job growth, population growth, rent growth. And so, I mean, what a lot of guys are doing, which we are not doing, is they are looking to do like a heavy lift, a heavy value add, and they're doing bridge loans where they have to do a lot of renovation. Our model and what we're looking for in our deals are we're looking for a light value add. Okay. And by light value add, I mean, we're looking to find deals that need exterior paint, amenities, maybe fix some capital items like roofs or whatever. And then on the interiors, just do vinyl flooring, resurface countertops, paint the cabinets, washer and dryer install. So nothing too crazy where we have to gut the unit and put in a bunch of really nice finishes. We're focused on workforce housing. And so in order for that to work, Ryan, in this market with Phoenix, like I said, the prices keep going up. And a lot of these deals, the NOI on these deals are not spitting out enough money to even qualify for permanent debt. So that's why all these guys are doing bridge loans, because these deals are debt service constrained. Okay. And so we don't like to do that. I mean, we made an offer on a bridge loan for one deal, but it was not a heavy value add. It was an owner operated property, and the guy just wasn't doing a good job running his financials. So the bridge loan was really to correct the operations and do a light value add. So some of the things, yeah, exactly, where we can fix it. Exactly. So we're looking to put permanent debt on these deals. And in Phoenix, in order for it to work, we need to have a combination of 2 things. Okay. We need to have loss to lease in place, meaning that they are not pushing their rents to the market where they could be. So there's upside simply by burning off loss to lease and pushing the rents to where they should be. And we need value add upside, where there's some quote unquote meat on the bone, where we can renovate units and push the rents there. If we can get those 2 things, then these deals have a better chance of working. Because in Phoenix, the last 2 years, Ryan, it's been an 8% plus year over year rent growth. So if you have an owner who has not pushed their rents in 2 years with the market, they can be 16% below a market. You know what I mean? So if we can find those 2 things, then the deal has a better chance of working. People, and cut me off if I'm going too deep here. But
this is great. I think this is kind of the crux of what people are interested in.
Yeah, and people are always looking at a cap rate, Ryan, and cap rate is important. Don't get me wrong, but cap rate is a very misleading metric, I think. And the reason I say that is in Phoenix, like you see like a 4.5 or a 5 cap, and you say, oh, that's a crappy deal. It's too low of a cap rate. However, if you've got an owner or a seller who is not pushing their rents to where they should be, well, then that cap rate is artificially deflated because the NOI is not being pushed up as where it could be. So you could buy something. I mean, for example, our last deal on a trailing 12, it was like a 4.5 cap. On a trailing 3, it was a 5.2 cap. And that's because they're burning off loss to lease, pushing their rents up.
Sure.
So you have to look at everything with the deal and where you can push the rents based on comps, things like that. So for underwriting, we're looking for that. We're looking for loss to lease, light value add. Can we put permanent debt on it? We need 3 to 5 years of interest only to really make these deals work as far as achieving the cash on cash return that our investors want, like an 8 to 9%.
Sure.
We stress test these deals. And so, I mean, like I said, it's been 8% year over year. The last 2 years, it's been 6.5% average over the 10-year cycle here. I mean, we're assuming 3%. I mean, our previous deals, we assumed 2%, which was the rate of inflation. Yeah, exactly. Yeah. I'm sorry. Annual stabilized rent growth. So that means after you renovated, what's your natural appreciation? We're now assuming 3% per year, which is extremely conservative compared to where it's been. So it's assuming there'd be a significant recession. And with this stress test, we're saying we can hold through the recession and then sell in year 5, 6, whatever we have to do. Okay. And then the other thing is just kind of having the cushion between your entry cap rate, your in-place cap rate, and your exit cap rate.
Sure.
Okay. So I mean, we have 100 basis points of cushion between our entry and our exit cap.
Okay.
So I mean, obviously underwriting gets very sophisticated and there's a lot of other things that go into it. But I mean, those are some of the main points is you want to have conservative rent growth, the cap rate, cushion, and then loss to lease.
So I imagine with that criteria, which I think is, solid for, finding good deals and the right ones, I imagine in the Phoenix market, that must be pretty challenging right now.
It's really tough. Yeah, it's tough. And I mean, we feel fortunate that we actually acquired the 4 deals last year so we could get into the game, so to speak, so that we can try to generate better deal flow, like off-market deals, or at least have a better chance at winning the good on-market deals because the brokers now know us. Because you're right, it's extremely tough. Like we've underwritten easily, no exaggeration, 30 to 40 deals just the last 5 months. We've put offers on maybe 5 or 6, and we've gotten best and final on a few of them.
Okay.
And so we've been super close. I mean, one deal was 120 units in Scottsdale, and we did everything the broker said. He said, okay, you need to have this purchase price, this hard money, these terms for the contract. And we followed it, and it penciled. The deal worked for us.
Sure.
We sent the offer, and then we lost by $50K. You know what I mean?
Oh, that's tough.
Yeah. And so it's tough. Yeah. So these deals are really close. They're tough. I mean, inventory has been low in the fourth quarter. And so we're hoping now it'll really pick up. So.
No, that's I appreciate that. That's really helpful.
Yeah.
And then and for people getting into the business, obviously Phoenix is hot. Maybe you can just give us kind of an overview of what you see happening in Phoenix, kind of what the history has been, and looking forward, what your thoughts are on the market.
Yeah, no, that's a great question, Ryan. Good point. So when a lot of people hear Phoenix, they think of 2008, right? They think of the recession, and they hear horror stories of how Phoenix tanked in 08. And the truth is the single family home market did tank. Okay. It got hit hard. Multifamily, and especially the C-class workforce housing, did not do nearly as bad. It didn't do very, very poorly at all, actually. Because when a lot of these people lose their homes, they have to go rent apartments, right? And they're in workforce affordable housing.
Sure.
Well, another thing to note is that in 2008 in Phoenix, the jobs were heavily concentrated in construction. Okay, which is not a well-insulated industry, right? Because construction workers will take off wherever they go. Whereas now in Phoenix, I mean, and this is a statistic from the U.S. Bureau of Labor Statistics. We've used it on our webinars for our investors. It's 6% now of the job force is focused in construction.
Okay.
So the primary reason, there's really 2, but the primary reason for the growth in Phoenix just the last 10 years and how it continues to just blow up is all the job growth. I mean, now you've got your top industries here are tech, healthcare, like hospital chains, healthcare companies, financial services, insurance companies. So these job industries are just exploding. And then you also have massive growth as far as population. Okay, so Maricopa County, which is the county where Phoenix is located, has been the #1 county for the last 2 years consecutively for new population growth.
Okay.
You just have a mass exodus of people from California coming to Phoenix because multiple reasons. Taxes, cost of living is significantly cheaper here. And so, I mean, and the truth is for the workforce housing, the C-class apartments, there is actually a shortage of supply because there's so many people coming here that it's just driving the demand up like crazy. Okay. And these people in California are used to Washington State, California, they're used to paying so much money. And then they come here and they see, the rent's significantly cheaper compared to what I was paying, but there's jobs to support it where they can still make good money. And I mean, you've got a lot of people are now calling Phoenix the Silicon Desert because you got a lot of these companies, Silicon Valley, that are moving to Phoenix because it's just more business friendly, So you got Google is building a $1 billion database. You got Apple is building a mega database warehouse out here in Mesa. You got Bill Gates just bought a couple years ago $80 million of land in the West Valley. He's building a smart city. It's like a smart city through Microsoft. So you've got a lot of stuff happening here. That's why it's really booming. So we feel like with Phoenix, I mean, it's only getting stronger and stronger. And as far as like what my outlook is for the future, Ryan, I know we had talked about this before, is that I don't think the growth will continue at this pace in Phoenix. Okay. I don't think there's going to be, and obviously I don't have a crystal ball, so take this with a grain of salt. This is my own personal opinion just from living here and seeing everything. I think that there will not be a significant recession like there was before. I think it's so well insulated as far as jobs and population growth. I think the velocity of the growth will slow the next couple of years. And what if that means going from 8% rent growth year over year to 6 or 7%, or down to 5%, which would be significant. I think that the rents keep going up, and at some point there's going to be some type of affordability issue. You know what I mean? Because the rents just keep going up. It's like crazy. And so I think that the velocity will slow. I don't think there'll be like a significant crash or anything like that, because there's too much going on.
So, with your goal to acquire, number of units this year, you think about kind of that thesis of, rent growth slowing and just because affordability is getting out of whack. How are you, structuring your deals or underwriting, or just, thinking about protecting, your investors and, your principal capital, in case for that slowdown?
Yeah, no, great question. I mean, for us, it's all done on the front end, really, with that stress test when we do the acquisition. So, I mean, if we have an 8% year over year rent growth in place last couple of years and a 6.5% over the 10-year cycle, and we're assuming it's going to be 3%, then we're well protected against something like that. I mean, even for it to go from 8% down to 3%, it's not going to happen in a year, more than likely. That's going to be at least 2 or 3 years, just from all the research we've done. And so it's really the stress testing on the front end for the acquisition that protects our investors' capital, because it assumes that there's going to be a significant recession. And if there isn't, then that's all upside. So basically our returns have to be desirable, assuming a significant downturn. Okay. And that's therein lies the stress test. And so, yeah, that kind of contributes to your previous question of that's why it's so hard to find deals, because there's other groups out there that they have more aggressive assumptions, and they may be right. We just don't feel comfortable with that because you never know. So
it sounds like, that's all great points. And it sounds like you're really focusing on buying right and being disciplined in the process.
Yeah, it's a strict criteria. And I mean, and as far as we touched on like the goals, and it's like, well, okay, it's hard to find these deals, and prices are getting more expensive, which are basically pinching returns down. How are you going to possibly acquire that many units? Sure. And I've been thinking about that a lot. And for us, it comes down to cost of capital, right? The cost of capital is the expectations that your investors have for a return. Sure. Right now, our investors are made up primarily of working professionals, engineers, IT consultants, physicians, attorneys, high W-2 earners, or just friends and family. Okay. And these types of investors, they want like an 8 to 9% cash on cash. They want a 1.8 to 2x equity multiple, sure. which is industry standard, right? Yeah. And it's tough to find that in this market. And so what I've really been, as part of like focusing on acquisitions for our company, what I've really been focusing on is speaking to alternative capital sources. Like I've been talking a lot to very experienced, heavy capital raisers, institutional type of equity sources, because these guys, it's crazy. When we look at some of their deals, when we look at the market, well, these guys are buying A-class deals, Ryan. And like, you guys are buying these at like 3 and 4 caps, and the returns sure. can't nearly be as desirable. And I talk to some of these guys and they say, well, yeah, that's because our investors, they want to stash their money in a safe tax shelter. Right. And they don't need an 8% cash on cash. They're happy with the 4 or 5% cash on cash. They more so just want something in a safer asset, a safer vehicle than the stock market. And that's why they're buying newer properties, because there's less risk, right? They're newer builds. There's not deferred maintenance, things like that. So if we can find, we basically just need, it really only takes one capital source. If we found one capital source that's institutional level, or even if it's a family office that sure. trusts us, we like to work with them, then the sky could be the limit, because then we can be more aggressive on some of these deals. And I don't mean aggressive in regards to the assumptions, because you want to protect your investors, but the returns don't need to be as quote unquote sexy. Like if your investors don't want an 8% cash on cash, they want a 5%, they're happy, then the deal works.
Sure. Absolutely. No, really appreciate that. So yeah, we talked about the Phoenix market, that just some really good insights for folks. I mean, there's been a lot of attention there. And so just kind of switching gears a little bit, maybe just talk a little bit about, walking away from your career, some of the, adversity and kind of how you keep yourself going day to day, and some of the challenges that you may face, just kind of taking it to a deeper personal level here.
Yeah, absolutely. Yeah, no. So yeah, in hindsight, like I said, it sounds kind of cool. Like, oh, this guy quit his job, but it was not like I planned to do it for that long. I say 12 months, but every week and every month was really tough mentally. Like I went through a lot of personal adversity because I went from getting fat paychecks every 2 weeks to just burning through savings. And every day I wake up and I'm like a grinder. I want to go and do something. And with the hospice job, my target was clear. You know what I mean? It's like go out there and market and get commissions and be transactional. And now I wake up every morning and I don't have anywhere to go. I don't have anybody to report to. I have no accountability. It's just me. And I wake up every morning. I'm like, how do I move the needle today? Like, what do I do? Do I read another book? Do I listen to a podcast? Do I call a bunch of property management companies and meet with them and vet them? And so those are the things I was trying to do. And it's really tough when you read all the books, you listen to all the podcasts. I mean, the first step I realized was, okay, I can only do so much by learning. I have to meet with these people. So that's when I started meeting with the brokers and the lenders and the property management companies. And I was terrified, right? I was so nervous, you know what I mean? And I was like a marketing guy, so I'm used to meeting with people.
Yeah, sure. You have a great personality.
Yeah, no, thanks, man. But I felt like I didn't belong, right? I felt like intimidated. And so once I got over that, I was like, okay, great. I meet with all these people, but now you have to find a deal. So it's really tough. And it almost got to the point, it sounds kind of crazy. It got to the point where it had been for so long. I was just like, you know what? I don't even want like a crazy good return. Like I just don't want to lose my money. You know what I mean? Because when I quit my job, I had $260K. Okay. I spent over $30K to join a mentorship program, which I don't regret because I met a lot of good people and built my network through that. I was living off savings, so I burned through a lot of money. I spent like 40K renovating my house because I was an idiot. So don't renovate your house when you don't have a job. Like it's something I already planned. I was a freaking idiot. And so by the time I finally found the first deal, it was 10 months, right? 10 months of no job, just like all in multifamily, trying to figure it out. And I had like 162K left. Okay. And I put 160K into that first deal. I said, screw it, I'm all in because we needed to get,
that's awesome.
we needed to get 1.4 million. You know what I mean? We needed to get 1.4 million and we needed to figure it out. So anyways, I lost my train of thought, but we made it happen. So I put nearly all my money in there. And then I just got like some like odd, like 1099 marketing jobs that barely paid anything, just to try to get by. And, yeah, it was crazy. I mean, one turning point for me was we were under contract for our first deal, it was a 36 unit. And I realized, okay, I'm out of liquidity. Like, how am I going to do the next deal? My goal was to get a bunch of units. And we were sitting in this house, right? It was my first house. I had owned it for about over 3.5 years. And I was never going to sell this house, Ryan. Like I love the house. I was going to live in it for a long time. And then if anything, if I upgraded and bought another house, I would rent this one out. But I realized we're sitting like on 120K of equity, like a little over 100K of equity. And so I told Grace, I was like, babe, we got to unload this house. And when we decided to do that, because we were under contract for the first deal, we didn't even close it. And I was just trying to plan for the next one. So we moved out in December and we were renting like a apartment condo deal and listed the house. And it was at that moment that I was kind of like, okay, we're all in and Grace is all in. And that was kind of a turning point for us because now it's like, okay, we got the first deal under contract. We'll hopefully close it in a month or two. And now we're ready to go. And it was crazy because we closed on the house, finally, like closed on it in April. It sat, which was another frustrating thing. Like another advice is don't move into an apartment and list your house. Just live in the house till it sells. Because we were paying rent and a mortgage. But I was like, no, it'll sell faster if there's nobody living in it. But, but anyway, the house sells, right? It closes. And the next week, I wired 100K of hard, non-refundable money into a portfolio deal of 2 deals. It was a 59 unit and a 76 unit. And people think that's crazy, but we had already done like an access agreement and we knew the deals were solid. But if we didn't raise the money, I would have lost 100K. You know what I mean? So there is risk here. And there's been multiple times. It's always scary. So it's never like, oh, you do a deal, you're like a real estate mogul, you're a badass. No, like there are multiple times where I have that deep pit in my stomach. Like
absolutely.
the first deal, we had such a shady seller. He was trying to screw us over. And I literally thought I'm going to lose $30K of earnest money on that first deal. And I was such a sick feeling because I had already burned through so much money.
Sure.
So yeah. So, I mean, you have to just take these calculated risks, make sure you have professional management companies, all that stuff. But that was kind of a turning point for me when I knew that was when I knew I was really all in.
No, that's awesome. I love that story. And, that takes a lot of courage and, to really, go after and chase your dreams. So appreciate that. That's really inspiring.
Yeah, no, thank you.
It sounds like you mentioned you're reading a lot of books, and what have been the 3 most life-changing books for you?
Yeah, it's tough to say. Ryan, because I read a lot of books over that time. Like, I had a lot of free time, obviously, so I would like go to the gym and listen to audiobooks. And just to be clear, like, I don't really read actual books, so people know, because I'm too anxious and I get bored. So I listen to audiobooks like while I'm at the gym or driving, whatever. But I mean, I think I think like 3 foundational books that are good, and they're kind of cliche books. Everybody's read them, I feel like. But I mean, Think and Grow Rich is one. How to Win and Influence Friends is a good one. And Think and Grow Rich has just really helped me. Like, there's a couple different chapters I bookmarked in that I listened to repeatedly. Like, one of them was about faith and envisioning your goal. I listened to it like almost every day for 2 months, no exaggeration. You know what I mean?
Awesome.
I was really trying to envision something that seemed so out of reach. And then a third one I really like is called Can't Hurt Me by David Goggins. So he's like a former Navy SEAL, and it just talks about like mental toughness, not making excuses for yourself, and being accountable and persevering. There's a lot of these different books. I think a good book too is Psycho-Cybernetics. I really like that book. It talks a lot about, again, having faith, envisioning, and it has like a Christian context, which I like. I'm Christian, so I believe Jesus Christ is my Lord and Savior. And I think that was a big thing for me, is to have the faith and believe. So Psycho-Cybernetics is good because it kind of combines those.
That's great. I have, hadn't heard of those 2, so appreciate that. That's definitely, we'll check those out. Because you had told me about the Miracle Morning, and that was.
Oh yeah, the Miracle. Yeah. Sorry, the Miracle Morning. What an idiot! Miracle Morning is also in the top 3. So just push out one of those other ones, whatever one you want.
Yeah, so top 3 has 5 names on it.
Yeah, Miracle Morning is a really good one. In the summer of 2018, I read that, and I started doing that every morning. For those who don't know, just real quick, it's like wake up, hydrate, have silence, pray, meditate, whatever you want to call it, workout, whatever. I won't go into all of it, but I do it almost every morning. And when I don't, I notice it. You know what I mean? So it provides me with extra mental and physical energy. So Miracle Morning, I recommend everybody reads that regardless of what your goals are.
That's great. That's fantastic. Is there anything that I should have asked you that I didn't, as we kind of wind down?
I don't think so. I think that, if people are just trying to get into it, just realize, like I said earlier, you do need to attack, and you need to constantly be trying to move forward, but just try not to be too hard on yourself or get too discouraged if you don't have immediate results, because that's what was happening to me, is that I would push. And when something didn't happen, it's hard to tell that you're making progress. But there's a book called Mastery by Robert Greene, and he talks about like the 10,000 hour rule. Like, when you put in 10,000 hours is when you become an expert at something. And so when you're putting in hours, listening to podcasts, learning, driving deals, it may feel like you're not making progress, but the wheels are really turning in your brain. And so you have to just be very patient and just keep pushing. And there's that cliche about like a rocket ship, like most of the energy is spent just getting off the ground. And then once you're in the air, you can take off. And that really applies to multifamily. I feel like you just need to get the first deal. Then you're going to have a lot of confidence and experience. And after that, you're going to get into a rhythm. Like, you kind of know the blueprint, and you just rinse and repeat, and you can have exponential growth after that. So I think the biggest thing I would say is just continue to push and take the action, but don't get discouraged if you don't see the immediate results.
No, that's fantastic. That's great advice. Really encouraging for folks. One thing, as I was kind of looking through the notes here, is, you have a big goal this year to acquire a lot of units. You've been very focused on Phoenix and Arizona. How do you think about looking outside of the state, and what are your thoughts on that? And kind of, just, is there a when, or is there a no, actually we want to stay laser focused? So how do you balance that focus versus, opportunities elsewhere?
No, yeah, good question. So we actually talked about that. So we closed the deals in August, nothing was happening. and by October, it had been a few months, and we're like, man, we can't find any deals. And we had this conversation, Robert Bickron and I, should we look in other markets? And so, I mean, we looked at some deals in Tucson, toured some deals in Tucson, which is still in Arizona, but it's it's like 2 hours south of Phoenix. We were looking at Vegas. We were talking about it. And ultimately we decided, let's be patient and focus on the first quarter here in Phoenix. And it's just because, I mean, we honestly don't want to do a lot of traveling, and we don't feel comfortable at this point. We haven't put the research into another market to really feel comfortable. So if we commit to that, I'm not saying we won't, we really need to learn the fundamentals of that market. And so it is something we've definitely talked about, because it's hard to find deals in our backyard. But I think if we can get a different equity source with a different cost of capital, we could really scale up in Phoenix. If not, then we put in other markets.
Got it. No, I appreciate that. So Zach, tell the listeners how they can connect with you.
Yeah, you can go to our website. It's zhmultifamily.com, no hyphens or anything. You can email me. It's Zach, Z-A-C-H, at zhmultifamily.com. If you want to get on a call, you can schedule a call on that website or email me. You can also just shoot me a text, and I'll get back to you in like 48 hours or so, and we can set up a call. My phone number is 602-859-5458. So just shoot me a text. I'm happy to help however I can. So
that's great. Well, really appreciate you making the time for us, Zach. Always good chatting with you. And that was very inspiring and insightful, and really appreciate your time.
Yeah, no, thank you. I appreciate it, man. I'm grateful for the opportunity, and I'm excited to see your podcast grow. So I think it's going to blow up.
Awesome. Thank you so much. Appreciate it.
All right. Thanks, Ryan.